But, there's a distinction between what you're going to send to somebody that they can read in the privacy of their own home with the other people who might be helping them make that decision to invest, versus what you're going to present on a 30-minute webinar.
Sure.
Right? You get 20 minutes of content and about 10 minutes of questions, and then somebody's interested, you're going to want to send them something in more detail. And so that's what the investment summary is. It's 15, 20 pages. It should be nicely designed. It should have some nice, pictures of the property in it. And it should have some certain financials, like how much money are you raising? What are you going to do with that money? Like, where's the money coming from? You're going to get so much from a bank. You're going to get so much from investors. And then how is that money going to be spent?
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
All right, Kim, welcome to the show. How you feeling today?
I'm feeling great. Thanks for inviting me.
Hey, thanks for being here. So we'll get right into the podcast. I always like to start with people introducing themselves. So in your own words, I'd love to hear you introduce yourself.
Well, I'm Kim Lisa Taylor. I'm a corporate securities attorney and the founder of syndicationattorneys.com. We help entrepreneurs create successful investment companies. A lot of our clients are real estate, but we have some business clients as well. And we help. I've written a couple of books on how to legally raise capital and private money. I've got this one. I've got that one. So I've just I'm on a mission to teach as many people that want to know how to legally comply with securities laws and how to use them as a tool to be able to raise all the capital that they need. And, that includes complying with the law, understanding what laws you do have to comply with and what those mean, but also knowing how to properly structure your deals and the corporate structure so that you have things that make sense to investors and they want to invest with you.
Yeah, well, that's an extremely important thing, and I'm sure. How have you seen the evolution of the business over the last few years? I started 10 years ago, and there wasn't like Facebook ads, and the way people do advertising on LinkedIn and all the content generation and things like that. Back in those days, we got a lot of clients from bigger pockets. And that was very much like that was a content first, value, and there really wasn't ever like a pitch of what the investment is compared to like what you see on Facebook, where it's like, 12% return or, 2x or this and that. So like, how have you seen that evolution? And then I'm sure that the fund management space has brought a lot of new people into the market over the last few years, right? So how has the business evolved since you've been in it?
It hasn't evolved as much as you think, Peter. It's a relationship business. Anybody reaches out to you from a Facebook ad, they want to get to know you before they invest with you. They're not just going to, see your ad and start sending you $100,000 checks. And if they do, you better be suspicious.
They're working with the cartel or something like that, or
exactly. Yeah. Things you can go to jail for.
Yeah.
It's really a relationship business. I always tell people, if you want to do this low budget, just go out and get out in your community and join as many groups and meet up as you can with people who do things you like to do, not real estate related, really, because if you go to real estate groups and you're competing with everybody else in the group and there's always someone more experience than you, just go out and hang out. If you've got a spouse, then you go hang out with your spouse and meet some new people. And, the conversation comes around. People want to get to know you. They want to know what you do. You want to know what they do. And you keep showing up at those meetings. You've made some new friends, some new acquaintances. They know you as a real estate investor. And your job is to educate. You don't pitch. You don't need to sell. All you need to do is to teach people and, explain to them how they can participate and how it's of benefit to them. And, once you've done that, when you have a deal, they'll be interested. They'll be saying, yeah, let's do it.
Yeah, there's it takes a certain kind of personality, to do it that way. And I've had some friends that have extreme success that way. It's just, it's unbelievable. They can go to a restaurant and walk away with, potential leads for an investment. And then, there's other people that maybe aren't as comfortable doing that. But I agree with that. I think that's a great way to do it. You kind of start local. And then a lot of people will tell me, in their marketing, like some of that local like event participation and things like that, that those pictures and stories go a long way when they work with investors from like a national perspective and all. So they put them on social media, and you're kind of getting the best of both worlds, right?
Yeah, you use your local contacts to build a loyal database of prospective investors. These are the people that will invest in any deal that you do. They just know you, they like you, they want to do the stuff you're doing, they see you being successful, they want to be there. Everybody else you have to convince.
Yeah.
Right?
Yeah.
So you can show them proof. They want to see the proof. Show me your track record. Show me how many of these things you've done before. And until you have enough of those things that you've done with your local core group, they're not going to be interested in investing with you because they don't want to take a chance on you learning something new with their money and maybe screwing it up.
Yeah, that makes sense. Before we get too deep into the weeds, I was saying before we hopped on, you're the first securities attorney I've had on the show. So we should probably cover some, basics. I think one of those big things is, what is an accredited investor and why? That's a question I hear. I got a message through LinkedIn yesterday. Do you have to be an accredited investor? So what is it, and why does that designation exist?
So an accredited investor, there's really 12 different definitions of accredited investor, but the one that pertains most to people who are raising money for real estate are someone with over $1 million net worth, excluding any equity in their primary residence. So they can use all of their rental properties and any other investments that they have as part of that net worth, but just not the equity in your primary residence. And also, so I call this the 1-2-3 rule. So 1-2-3 rule. So $1 million net worth or $200,000 a year income if they're single, $300,000 if they're a cohabitating couple, and sharing the same address. Could be, family, could be, just a partner relationship, could be married. As long as you're sharing that same address, you can do that. And, there's another definition is any entity with over $5 million in assets, not being formed specifically for your investment, or any entity in which all of the members are accredited investors.
Okay.
Yeah.
Makes sense.
Those are the most common. There's a few others like, knowledgeable employees, people with certain securities licenses, and then some institutional players. But those are the ones that most commonly apply. So why is it important? Well, securities laws. So when someone is selling passive interests in an investment opportunity, okay, that's called an investment contract. And anytime you're doing that, you are selling investment contracts. Investment contracts are in the list of things that are securities in the 1933 Securities Act. There's a definition section. It's about a half-page long, and it has all these words and phrases in it. And one of them is an investment contract. The very first one, which a lot of people don't realize, is a note. So promissory notes are also securities.
Really?
Promissory notes and investment contracts are the two that most frequently come into play in real estate transactions. So if you're selling those things to retail investors, so we're talking about ordinary people who have jobs, have savings, have some investment savvy, those are considered retail investors, individuals, right? Versus selling it to, a hard money lender or something like that. Don't worry about what we're talking about are retail investors, people right? Or your friends, your acquaintances that want to invest with you. Well, when you're selling to those retail investors, then the 1933 Securities Act has some protections for those investors. And one of them is to make sure that they meet certain financial standards and levels before they're allowed to invest with you, so that you're not, going out and preying on the general public that doesn't know anything, and they're, putting all their hard-earned money into your deal, and then they don't understand those risks, and then you lose it, or something goes wrong and a property fails, and they lose their investment. Then they're maybe permanently harmed. So make sure we're dealing with people that have enough resources that it's not going to be a permanent harm situation if something were to go wrong. I've been the responsible attorney for over 450 securities offerings, helping people raise over 4 billion. I think it's almost $5 billion. And we've seen very few of them go wrong, but there are very few that do go wrong. And when they go wrong, they can go horribly wrong, and everybody gets their money. So it's a small percentage, but it does happen. And so that's what the 1933 Securities Act was created for. Within that act, the SEC has created some rules and saying, well, okay, if you want to follow these specific rules, then we can allow you to sell securities without having to go through a pre-approval and registration process. And so these are called securities exemptions. And the two securities exemptions under the federal law, which most people follow, are Regulation D Rule 506B and Regulation D Rule 506C. Both of them have some opportunities for accredited investors to invest. With the 506B rule, you can have unlimited accredited investors, so you don't have to count them. So that's up to 35 non-accredited but sophisticated investors. But you can't find them through any means of general advertising or solicitation. So you have to be able to demonstrate and prove that you already had a pre-existing substantive relationship with every one of those investors before you even start telling them about deals. So that means you've got to get out there, you've got to get to know people, you have to have one-on-one conversations with them, talking to them about whether they're accredited. If not, how might they be sophisticated? Do they think they could understand? If you throw 150 pages of legal documents at them, are they going to understand what that means and how to evaluate a deal? And so you can teach them those things. You can help them become sophisticated, but it really needs to be kind of a formal training process if you're going to do that. People. Otherwise, there's a whole lot of people out there that have already been trained. They've already gone through programs and learned how to participate in, syndicates or funds, things like that. So that's why accredited matters. So with 506B, you don't have to count accredited. And with 506C, you can actually advertise, but you're restricted to only accredited investors. And so they actually have to go through a verification process and prove to you that they're accredited in order to participate in a 506C deal. And 506B, they can self-certify, so you don't have to dig into their background or anything like that to prove it. You can take them at their word, unless you have actual knowledge that they're not being truthful.
Wow, that's a lot a lot to take in, I'm sure. What do you think investors, does it necessarily, from an investor's perspective? Because I always look at it from like the fund manager's perspective, but from an investor, any real difference? I mean, is 506B over 506C? Should they necessarily care, or what should they be looking out for if it's 506B or C? Because I would think if they're investing in a 506B, and maybe they saw an advertisement online or something like that, they should be weary, right? Same with like a 506C, if they're just filling out a questionnaire and not providing any backup to it and all. So what are some of the things that you would say as an accredited investor that they should be aware of going into a 506B or a 506C?
Well, when the person, which the SEC calls the issuer, so in the real world, we call them syndicators or fund managers. So a syndication is just a group of people that have pooled their resources for a common goal. So in the case, usually there's a syndicate manager or a general partner. If they're using a limited partnership structure, a lot of them use LLCs, so they use the word manager. But anyway, the syndicator themselves is this management. It's usually a team. It's not usually one person. It's usually 2 to 5 people who are putting this deal together, and they're going to be doing all the sweat equity. They're the ones that found the deal. They're doing the due diligence on it to make sure it's worthy. They're getting financing on it from an institutional lender in order to bring as much of that money as is needed to acquire the property, and then the rest is going to come from investors. So you've got to be able to really understand what it is that they're doing, and you've got to get some free knowledge of that. So from a 506B or 506C standpoint, does an accredited investor really care? Well, they sometimes, the more sophisticated the accredited investor, maybe they don't want to be in with a bunch of non-accredited but sophisticated investors, so maybe they only want to be in a deal with other accredited investors. But you do need to understand that securities laws require the syndicator to do these certain things. So if it's a 506B offering, they have to have a financial conversation with you to find out and ask you questions. Are you accredited? And they might read you those definitions and you can say yes or no. And if you're not, then they might give you the definition of sophisticated, and they're going to ask you, are you that? And if you say yes, they're going to say, well, why do you think you need that? And you're going to have to give them some information about that stuff. And they may ask you some additional questions like, hey, the types of deals we do, we typically hold them for 5 to 7 years, or, your money's not going to be liquid during that period. Is that going to work out for you? And when do you need the money? And, are you comfortable being in a deal where we might have to hang on a little longer if the market's wrong at the time we plan to sell? Just kind of talking about it and making sure that your investment goals and theirs are match up. If they don't, if you're saying, no, I only want my money out for 2 or 3 years, and they're saying it's a 7-year deal, well, that's not a good fit for you. But they may have a different place for you in their deal where they can be like, okay, well, we have some different opportunities for someone who wants to be in a shorter term. So, it just opens the door for you to explore things that do work. So, that's why you care. For accredited investors investing in Rule 506C offerings, you don't have to do the proof until you make the investment. So it's not like you have to, every time you fill out a form, they're going to ask you, are you accredited? You can say yes, but you're not going to have to provide proof of that until you actually, fill out a subscription agreement for a specific offering. And, they've asked you to send in your money. And at that point, you're going to provide that proof, which could be just a letter from your own CPA, attorney, financial advisor, or you can go to some third party services that'll do it for, $50 or $100. And you have to just give them some financial information and they'll produce the letter from an attorney, CPA, or someone with a license to vouch for you. And once you invest with, let's say someone invests with you, Peter, as an accredited investor, and they've gone through the verification process for your 506C offering, well, they don't have to if they want to invest with you again in the future, they only have to renew that every 5 years. Each new offering, you're going to ask them to reaffirm that the information they provided when they did their confirmation was still, is still correct. And as long as you do that, you're fine. And then at that 5-year mark, they're going to say, hey, we've got to do it again. Why? Because, people's situation changed. And that's why you put that rule in there. If you retire, you're no longer at that same income level. Maybe you're not accredited anymore by income, but by then, maybe you've accumulated enough net worth. So, you're just trading one definition for another.
Yeah, that's relatively new, right? Because when I started, it was almost every time. I think it was a little, I don't know if it was 90 days or something like that, but it was raising capital for a fund where it was like almost every time somebody came in, we had to do that verification process over again. Now with the 5-year look back, it makes things a little easier from an administrative standpoint. Is that new in the last few years, or?
Yeah, I think that changed in 2020.
That's a nice feature. So that's really good background on the difference between 506B and C, and kind of some pointers for investors to look for. You'd mentioned something about the different structures. And I think GPLP is one of those things that you hear so commonly, but a lot of times deals are structured in an LLC where there is no general partner or limited partner. I feel like limited partnerships are a little bit more rare, at least in this world. So explain the difference, because like we're LLCs. I mean, so we have like managing members, and then there's the passive members. It's typically the way I look at it. But what should investors be looking out for? I mean, so LLCs, limited partnerships, what are they? And then are there other options and things like that? What's the difference? What do they need to know when it comes to the structuring of the entities and that kind of thing?
Yeah, for real estate, the most common entities is actually the limited liability company. The traditional syndication structure from way back in the 70s when the first Rule 506 came out that allowed these country club deals. So let's talk about how this originated. Back in I think it was the 80s, people were complaining saying, look, the only way we can sell interest to, in a deal to our buddies legally is through a registered offering. That's hugely expensive. It takes forever to get it approved. We don't have time to do that when we've got a real estate deal we need to close on in 90 days. So, people who are at the idea was people at the country club were bragging to their buddies about, yeah, hey, I'm getting ready to buy this apartment complex. And they're like, hey, how do I get in on that? And so there's no legal way to do it. And so that's when Rule 506 originated kind of as the country club rule. So they said, SEC said, well, okay, if you're just bringing in people, and you're not going out and you're advertising like a public offering, then we'll allow you to go ahead and put those kinds of deals together. So at that time, the preferred structure was a limited partnership.
Okay.
And so that's where that language originated. So in a limited partnership, you have a general partner who is the active member who's doing all the work. It's usually, again, the general partner might be itself an LLC or another entity that has multiple members within it. And so they're the ones that are finding deals, getting the financing, doing the due diligence, overseeing the property for as long as they own it. And also then you're taking care of the investors, developing those relationships, helping them invest in the deals, and then keeping them informed of what's going on with the deal, providing financial statements, providing tax documents, those kinds of things for the life of the deal. So in that structure, the general partner, those are the active members, and then you've got limited partners. And by law, in a limited partnership, the limited partners can't assume active responsibility or they lose their limited liability. So the whole idea was you could put these people into these limited partnerships and the investors would not be liable for any losses beyond what they'd invested. Okay. So nobody could sue the company and then come after them for their outside personal assets, because that was a concern to these investors. Hey, if I invest in this deal, it goes horribly wrong. What liability do I have? So they have limited liability. They created limited partnerships for this limited liability structure. The general partner, on the other hand, continued to have unlimited liability for all acts of the partnership because they were the ones making the decision. So if, something happened, now if they created that general partnership as a LLC in itself, they created some limited liability for themselves there just by investing in a structure that limits their liability to their investment in that deal. So that's where that came from. Now, fast forward to today, everybody starts using LLCs. Well, every state in the country has a limited partnership act and they have a limited liability company act, and they define what we call the participants in these deals. So the states are the one that came up with the idea as limited liability companies came into being. They first started in Wyoming and then just kind of spread across the proliferated across the country. Well, the reason everybody likes LLCs, limited liability companies, not corporations, companies. Reason they like them better than limited partnerships because it removed that unlimited liability from the general partner. Is now the manager, which is what the states called them, is within that limited liability company structure. It's limited its liability to only its investment in that deal along with everybody else. So it became the preferred choice for syndicators and fund managers to use. And however, the old jargon carries forward.
That makes a lot of sense. Yeah, that definitely is putting the pieces together to why now that's so common that you hear that.
Yeah, and so technically, I cringe a little every time I hear that. Of course, it doesn't mean anything. It's not. It's not the right term, but it gets the point across. And the reason that we have this kind of confusion is because when you're in the real estate world, especially in commercial real estate, well, you also usually have a property manager.
Mhm.
Then now we have an LLC and it has a manager. So it becomes a little bit hard to distinguish for people that aren't familiar with all this terminology. Are we talking property manager here? Are we talking to the manager of the LLC? So another term that's come into being is asset manager.
Sure.
Okay. So whenever you hear somebody say GP, they're talking about the asset manager. Whenever you hear somebody say manager of an LLC, they're talking about the asset manager. Whenever you're talking about the people that are at the site collecting rent, dealing with maintenance issues, all those things, then you're dealing with the property manager. So property managers, I hate to use these terms, right? But they deal with tenants, toilets, and trash. And asset managers oversee the property managers on behalf of the group of investors in the syndicate. The syndicate owns the property. Okay. So that's how those names all come into play, and a little history lesson.
Yeah. Oh, you open Pandora's box when it comes to definitions, right? It's just that I always find it's best to just ask people what they mean. Sponsor is one of those ones that you hear all the time. I mean, sponsor, what do they mean by that? Because in some cases it's just the person signing on the debt, right? And then in other places they mean it as like the operator as a whole. So I got to think for somebody, and I remember when I was new to the space, and even now, I'm every day I'm still, there's still things that I'm learning on a daily basis, and I always think it's best. My advice to an accredited investor in this world, new to this world, or even if they've been around for a while, I think it's always best to just ask that question. If there's any confusion, maybe, just to be certain, what do they mean by that? When they say sponsor or operator or syndicator or whatever it may be, joint venture. What do they mean? Because sometimes I think a lot of, or asset manager is another one where not everybody necessarily means the same thing. What's up with that? When are they going to come out with a dictionary where if you're saying it, that's what that means?
Well, actually, the SEC has boiled it down. They just call it the issuer. You are the issuer of the securities if you're the people in charge who are contributing a sweat equity. We don't care about all those other names. You're the issuer. So if you ever get a complaint from a securities regulator, they're going to be complaining that the issuer did this, and they're going to mean all those things. The operator,
That's a catch-all to all of that, right? Okay, that's good to know.
if you're responsible for giving, so what is the security itself? Okay, that question's coming up. So we're talking about passive investors that are investing in these limited partnerships or limited liability companies. What is the security? Well, it's the piece of paper that you're given in exchange for your money. It's the contractual obligation, the promise to pay. And so if, there's always these multiple parts to a syndicate or an offering package. Okay, so we call it an offering package. I think that's the SEC securities regulators call it offering materials, which would encompass legal docs and any marketing materials that you create. And so all of those are regulated. And so, what can you expect? What kind of offering materials would an investor expect if they were going to be investing in one of these deals? Well, there's usually going to be, at the very least, an operating agreement. And that's going to become the contractual obligation, the governing document for how the company is going to be run from the date it begins operation all the way until the property is sold and the company is actually dissolved. So the operating agreement, as some, states got involved here too. Some states call it a company agreement. Some states call it a limited liability company agreement, and some states just call it operating agreement. So those terms are all synonymous as well. So that's the contractual obligation. That is the security. Now you're going to sign a subscription agreement. So the subscription agreement is where you're going to assert to the asset manager, the issuer, that you are qualified to be in that deal, that you met the financial qualifications for the exemption that was selected, whether it's a 506B or a 506C, or even, if everything's all contained within the states, so states have their own securities divisions. So they are have their own mini SEC, and they all have their own intrastate securities exemption. So if everything was in one state, the property, the issuer, and all of the investors, then they could just use that state securities exemption, but they have to state what exemption following, and then they have to be able to prove how they followed it through paperwork, through documentation. And so back to the documents you could receive in an offering package or the offering materials. So you're going to have an operating agreement. You're going to at least have a subscription agreement. The subscription agreement is where the investor asserts to the issuer, I meet these financial qualifications. I understand the risks. I understand I could lose all of my money. I can afford to take that risk. And here's how much I'm going to invest. Okay. So in most cases, you should also have a private placement memorandum. However, it's not required if it's an all accredited offering that you have a private placement memorandum. But if someone is doing a Rule 506B offering and they're going to include non-accredited investors, then they must have a private placement memorandum.
Okay.
The private placement memorandum is where all the risks of the investment are disclosed to you in writing. So typical multifamily risk section, about 7 pages long, because it covers tax risks, regulatory risks, corporate risks, how the company is structured, who the key players are, what if somebody, leaves or can no longer perform, how does that affect the company, the property itself, what's going on with the property is, depending on where it is, are there environmental hazards that, hurricanes, sinkholes, Florida, we have to deal with all those things. But, across the country, there's, California fires, there's all these other risks that could happen that could cause you to get an insurance check that is far short of the cost to replace and and all the lost income that goes along with that. So yeah, that's those are the typical documents you would see. Then the issuer themselves, they're going to have a separate operating agreement for whatever entity they're using for their asset management LLC or the GP LLC. They're going to have their separate agreement that describes their agreement amongst the members of the management team.
Now, would you say, I usually go right to the operating agreement. I feel like when I'm looking at deals, I feel like that typically sums up everything, right? If it's not in there, then it's not really locked in, right? I mean, would you suggest people to go there kind of for, obviously the PPM typically has like a business plan and kind of in there as well, and it gives some general, I think ours has some like little explanations of, certain things, but the operating agreement is that all encompassing, everything kind of lives in there. Would you agree that's a good place to go to? Or
I think if you're evaluating a deal, the first thing you want to look at is for an investment summary. So along with legal documents, there are usually going to be some marketing documents that go along with that. Like you might have received an announcement in a one-pager, right? An email announcement. That's called a one-pager. You might be invited to participate in a presentation where it could be you one-on-one or you and a group of other prospective investors. In that case, they're probably going to be going through a PowerPoint. We would call that a pitch deck. And that's just going to hit the highlights, and they're going to be talking about, some of the slides as they go, hey, here's how we calculated the returns. Here's how long we plan to hold it. Here's what it is. Here's what we plan to do to it to make it better, to increase its value so that we can have some extra money to be able to share with you from cash flow and also from the sale or equity that's realized on sale. And that document to me is the most important document. Some attorneys will embed that in the legal docs. We don't. I want the investors to be able to see that as a standalone because you really only have to read that. So we've got the pitch deck, the one pager, and then there's the investment summary itself, which is kind of the meat of the deal, right? So the pitch deck, skeleton version, bullet points, and then the description of everything, the more detailed description is provided in the investment summary or a property deck, some people call it, or so there's all these different words.
There's so many. Oh yeah, without a doubt. Because in my mind, I'm thinking like, okay, so like a pitch deck, and then you said there's the pitch deck. I'm like, oh god, there's separate things.
Some people, call their property information package a deck. But, there's a distinction between what you're going to send to somebody that they can read in the privacy of their own home with the other people who might be helping them make that decision to invest, versus what you're going to present on a 30-minute webinar.
Sure.
Right?
Mhm.
You get 20 minutes of content and about 10 minutes of questions, and then somebody's interested, you're going to want to send them something in more detail. And so that's what the investment summary is. It's 15, 20 pages. It should be nicely designed. It should have some nice pictures of the property in it, and it should have some certain financials, like how much money are you raising? What are you going to do with that money? Like, where's the money coming from? You're going to get so much from a bank, you're going to get so much from investors, and then how is that money going to be spent?
The use of proceeds.
You've got, sources and uses of funds. That's a requirement for securities offerings under these exemptions. The SEC wants something to show that information, so investors know what they're investing in and how their money will be spent, and also so that you can look at how much of that is going to management fees, and you can decide, hey, is so much of it going to management fees that only less than 85% of it is going to actually acquire the property. That's called load. And so you want to be looking at that. And if it's too high, then maybe that's not something you want to invest in. And, so it should be within some industry norms, which is less than 15%. So they've got to cover closing costs. There will be an acquisition fee to the manager. So you should be looking at those things. How much is the acquisition fee to the manager? Do I think that's a reasonable amount? A reasonable amount could be between 1% and 5% of the purchase price, depending on the purchase price of the property. The smaller the purchase price, the higher that acquisition fee. The larger, the lower the acquisition fee. So 3% is pretty common for $2 to $5 million deals. Once you get above that, you might see some lower acquisition fees. And if they're less than $1 million, you might see some higher acquisition fees. And the reason is because it takes as much work to get a smaller deal done as it does to get a bigger deal done. And at some point you get into economy of scale. So, you've got to have some money for these capital improvements. So a lot of these syndicators will buy what are called value add properties, where they're going to buy something that's maybe not running optimally. Maybe it's a mom and pop deal and they haven't done any renovations for a while and the rents are below market. So the new buyer, your group, is going to come in, take it on, raise enough money to be able to go in and upgrade the units, increase the rents. Now you've got some additional cash flow that can be shared with investors. And every time you do that and you increase the rents, you kind of optimize the expenses. Over time, you're going to build what's called equity. Right. So as your net operating income increases because you've been able to implement all these improvements and get everything running at a more stabilized occupancy at current market levels, then at some point the group is usually going to try to sell. And why do they sell after 7 years? A lot of people don't know this. A lot of the reason that properties sell after about 7 years is because you have to start renovating again. So you got to bring in additional cash, and it's hard to do that with your current group because it ends up diluting everybody's return. And so, usually they'll sell to another group. They'll come in and do the same thing. They'll do the new upgrades and so forth. But then that net operating income is used to calculate what you think your exit sale price is going to be. And in order to determine all that stuff up front, you don't know what the market's going to be like 7 years from now, but you have to make some assumptions. You can say, hey, whatever the current market's doing, we'll assume that it's going to be similar. Maybe it isn't, but we like to do that. So if you make some assumptions, the assumptions could be wrong, but still you're adding value. Usually, even if you're in a downturn market at the time you're planned to sell, you usually just have to wait long enough, hold on, and it'll go back up. So instead of holding it for 7 years, maybe end up holding it for 10. And, that's one of the risks that you have to assume when you're investing in these deals is maybe we're not going to be able to sell when we hope to because because the market's wrong, or there's too much competition or, something. And so we're just going to hang on a little longer, ride it out. Eventually that's going to iron itself out. We're still going to be able to generate the profit and move out.
Mhm.
Yeah.
So, Todd, is there any material difference in the documentation that investors should be looking for investing in a syndication, which I'm thinking of like a one-off deal? Yeah, I mean, like you said, say it's a 200-unit apartment complex, you got a value add strategy or whatever the strategy may be, versus when they're investing in a fund that's going to go acquire, 2, 3, 4, 5, or something like that. Anything that they should be looking at, anything they're going to notice differently in the documents, or is it all pretty much the same?
No, there's some significant differences. The returns, so in the operating agreement, you mentioned you like to go the operating agreement, right? There's usually a couple sections that I would always say that once you look at the investment summary, now go to the operating agreement, look for two things. Look for management fees and look
That's usually where I go first. And the waterfall, I always want to see, how after that.
distribution section, and in that distribution section is going to be a waterfall. And the waterfall, what it is, it's like a cascading pool, right? Or cascading stream with a group of pools. And so at each level, there's a stop and you do something, and then you go to the next level and you do something else. So maybe the first level is we take care of this certain class of investors and we pay them some fixed return for the year, or some benchmark that we're trying to achieve. That's called a preferred return. So when you get to that level, once we've achieved that, then we go to the next level. Maybe there's something for management. And then the next level after that is, some kind of a split. If you run out of cash, you got to stop. Right? You can't go anywhere. That this dries up. There's no more water for the next pool. But eventually it will catch up. And so the idea is maybe the first couple of years, there's not a huge amount of, all that stuff. Maybe you're a little deficient, but you can always make that stuff up later as you increase the operational cash flow, or you get to scale and you look back and you say, hey, were there ever any years, first couple of years when we were trying to make all those improvements and we were, re-renting the properties at higher rates before we got to stabilized occupancy, there might have been some deficiencies in preferred returns that you'd offered. And so you got to go back and make that up. And then at the sale, the first thing that should happen is the investor should get their money back. Now, I will tell you, there's a lot of attorneys that will write offering documents that say that you make up the preferred returns first. I advise my clients not to do that. And the reason is because once you give everybody's money back, what do?
Sure.
This wasn't a bus. My wife's not going to kill me. I'm okay.
Yeah.
Money back.
There's a sigh of relief.
Yeah. Whatever you get after that is a big bonus, right? But if you do it the other way around and you pay back the preferred returns first, and then they go to giving your money back and they're like, oh yeah, but y'all got your 8% every year, but now we're only going to give you back 80% of your money. Hey, that you're going to feel like, oh crap, I got cheated, right? Yeah. You're going to feel good about it. So invest. I think, I try to remove the liability from my investor or from my clients as quickly as possible, so that, their investors are more comfortable and they're more comfortable, so that everything flows smoothly. I think sometimes if you get things backwards, you could end up in a really awkward situation where people aren't happy, where if you just flip the order, they might be perfectly content.
Yeah, that makes a lot of sense. And a great information for an accredited investor looking at that, to go to there and look and see how it's structured and all. So Kim, you're an investor as well. There's been some nuggets throughout where I'm thinking, okay, this is what you look for, but let's speak directly to that. So what are some of the things that you look for? What are some of the red flags, and what are some of the things that kind of get you excited, or you feel like, okay, they're doing things the right way, and would make you, want to invest?
I think if somebody can lay out an investor communications plan that they plan to follow, that goes a long way. I've rarely seen it, but
What do you mean? What do you mean by that? Just from like just making it accessible and where you can understand what they're doing and all, or what's that look like?
well, there's a couple of things that everybody needs to do, but nobody does. And number one, if you're raising money from investors, you need to have an investor marketing plan.
Mm.
You can't launch a business without a marketing plan. So why would you launch this business without a plan? How you're going to get paying customers who are your investors, right? So you really need to think about, how am I going to meet people? How am I going to develop those relationships? How am I going to educate? What kind of marketing materials am I going to provide them along the way to keep engaged? And making sure that they're ready, willing, pre-vetted, and able when you have a deal. And that's really key. And then the other one is a post-deal investor communications plan. So, hey, we're going to hold quarterly meetings, and or we're going to send out a quarterly newsletter. Quarterly is usually enough for these deals. If you start doing it too frequently, people get a little nervous. They think you don't know what you're doing. And you got to be super careful in, say, a commercial real estate deal that depends on rental income, and, where you're making improvements on property. You've got to be super careful about monthly returns, right? Because that means you've got to calculate that waterfall every single month. That's a lot of work,
Sure.
So you're probably more realistic and maybe serving your investors a little better if you do it on a quarterly basis. For one, you're not, spending all that extra time, maybe even engaging bookkeepers or accountants to do unnecessary accounting work that costs the company money, but also just, keeping people apprised on a quarterly basis. What's going on? This is, things don't happen so quickly that you have enough information to give them a monthly status update.
Sure.
It's like nothing happened this month. The second.
Yeah, exactly. Yeah. When we first started, we did weekly, and it got to that point where it's just like you're saying the same thing every week. Yeah, and even monthly. Yeah, we do quarterly now, and have done it for a while, because at least that gives some, you have a substantive conversation, on a quarter to quarter basis. Whereas, anything before that, it's just sometimes you're moving the needle enough, but a lot of times it's just kind of just day to day business operations. I mean, nothing really exciting to report on.
The other thing to be cautious of when you're in looking to invest, and certainly I do, is people that are making promissory statements, right? And the SEC highly, highly frowns on this. So they'll ding people for doing it, saying it's technically fraudulent. If they're promising, hey, we will do quarterly distributions, well, they may not, because all of a sudden COVID happens and rent and moratoriums happen. They can't keep making quarterly distributions and still pay the mortgage.
Yeah.
They've got to suspend the quarterly distributions in order to salvage the investment and to maintain it, which is in your best interest. So, beware of people that are promising quarterly distributions. What they're doing is they're evaluating distributions on a quarterly basis, and then they're informing you through their investor communications plan as to how they're going to be, whether or not there is a distribution, and when it's going to be made, and the progress that they've had at the property. If there isn't one, why? And what's going to happen with that money that would have otherwise been used for distributions, and it should be going back into the property. And so just beware of those things. Look for people that are guarantee. You can't use terms like deed, but also look for high pressure terms. The SEC completely frowns on high pressure terms, like move now, get your investment in today, and like that. They don't like that high pressure. They don't like terms like high yield. If there's comparison terms, compared to what? Hey, best deal ever. Well, you can't say that it's the best deal ever because you haven't seen every deal. That's better. And so be careful of people that are making some claims that can't be substantiated. Because those people are really not in tune with what is legally allowed in those offering materials. And so maybe they're either not having somebody review their offering materials, or they're not going to give advice. And anytime somebody is not following securities laws, okay, then they are breaking the law. And it's putting your investment at risk. And the reason for that is because if they get in trouble, if they get a letter from a state securities regulator or the SEC, then they're going to suspend distributions while they pour money into legal fees, pour
Mm.
your into their legal fees
Mm.
to defend what they did. And if they did it wrong, that money's going to be gone. And, there could be fines, there could be all kinds of things. So if you can see that someone is not following securities laws, then you really don't want to invest with them. It doesn't matter how good the deal sounds.
Yeah.
It's not as good as it sounds. They don't understand securities laws. They don't understand their obligations, and they're not meeting them. So they're already not meeting their obligations. Why would you want to invest with them? Because the next obligation they don't meet is the one they have to you.
Wow, that's such great information, and I think it's so important because so many people get caught up on the due diligence of the deal, and the numbers, and kind of making sure the underwriting and that kind of stuff and analysis is correct. And then there's that whole other side of due diligencing the operating team. And if you know what the securities laws are and what they can do and can't do in a 506B versus C or whatever your structure you're investing in, that right there could send off some quick red flags to make a quicker decision. Because, like you said, if they're not doing those certain things, kind of leads to what else may they not be doing. So I think any accredited investors who are investing in the space that have taken the time to understand the underwriting of whatever it is they're investing in, if it's self-storage or multifamily or single family or lending. It's important too to take that time to understand and educate yourself. And you have some great books that talk about that, and we'll talk about that in a second. But I'm curious, is there any asset classes that you like more so than others right now, just from a personal perspective? Anything that excites you from an asset class perspective? You might not get asked that question very often. You probably still to the legal side, right?
That's a nice little segue. For the last couple of years, we multifamily has been dominant in this field very long time. And, and I think it's because everybody understands. I mean, we've all either lived in an apartment, known somebody who's lived in an apartment, or, maybe owned a rental property or, whatever. So we all understand that model. It's a pretty simple model. But when you get into how do you get tenants in a retail shopping center, how do where the heck is all this stuff that goes into all these self-storages?
Yeah. Oh my God. Sure. Yeah.
I mean, when you start teaching the model, I think it's an education process. You have to teach people. We've actually had a lot of people doing a lot of really interesting things. And so I started interviewing everybody of our clients that had been doing all these different asset classes over the last 6 months or so, with the idea that I'm going to publish it in a book. And actually, I'm planning a virtual event for June where we're going to be, it's called Go Beyond Multifamily. Go Beyond Multifamily. Think about things you can invest in, not just for active investors, but also for passive investors to learn about these different asset classes. But I've seen people doing some really great things and getting some great returns on, land flipping, land, you get it entitled and then you turn it around and sell it to a builder. I've seen people doing a lot of land development, learning how. Just interviewed someone on our podcast last week about
I saw that.
Yeah, that
built to rent and all, very, very popular.
Built to rent. I think it's all, anything. I mean, I saw somebody who's doing like a Grand Prix, where they're going to have all these cars these high performance cars come in a place where they can store them, where they can be worked on. It's just, there's any kind of different model you can think of. We've got a lot of mobile home park investors, RV park investors. Just there's something.
There's so many different ways, right?
Yeah, medical office. You drive down the road, anything that you see that as a commercial property, somebody owns it, and there's paying tenant in it, or they're in it and running their business from the property they own. So it's all investment property.
Well, I think that's going to be a really great book, and because you make a good point. I think a lot of people kind of start with what they know, single family, multifamily, lending is the next kind of way of, because your asset backed is is that single or multifamily property, but there's so many more things out there, and sometimes things resonate with you more than less. Like I spent time in commercial brokerage, and that's where I was really able to understand like leasing industrial properties and retail, because an investor, you think to yourself, like, who's filling all this space? And it's like, if you can't envision who's filling the space, then it's going to be hard to invest in that asset class. And I think that's why residential typically makes it an easy introduction for people, because they can picture a family, or people out of college, or young professionals, or whatever it may be. So I think that book is going to be extremely helpful. I love your other books, and I wish I would have brought it with me. It's downstairs where I work, because I always find myself flipping through it. That's How to Raise Capital for Real Estate Legally. I use that at least once or twice a week. Yeah, you have a great dictionary at the end there, where there's terms and stuff. So that's a great resource. Tell the listeners how they can find out more about you, and get involved and get some of this content and resources that you have available.
Yeah, go to our website, syndicationattorneys.com. If you'd like, a free copy of our books, there's a free book tab. We're going to ask you a question. If you're a beginner, we're going to suggest you get this How to Legally Raise Private Money. It's only 168 pages, super easy read, kind of a step-by-step how syndication works. But the last chapter in both these books is for passive investors. So my, reason for putting that in there is because I think that as a passive investor, you're going to be much more equipped to understand who's doing it right, who's doing it wrong, who you want to invest in, what to look for if you understand this. This one is more like a desktop reference. It's a real an extension of the other book, but I wrote it so that it could be like an encyclopedia. Go to the table of contents, pick the chapter that you want, go read that chapter, and you'll know what you need to know about that thing. So check out syndicationattorneys.com. and go to the free book tab if you'd like a free book. If you'd like to schedule a call with one of our staff, you can schedule a free call there, or you can schedule a paid consult with me.
Awesome. And you have a great podcast too.
Yeah, we do. It's called Raise Capital Legally. And
Awesome.
and YouTube channel. If you go to our YouTube channel, please subscribe. We're trying to build up our subscribers. One of the assets classes we didn't talk about though, Peter, is investing in debt, right?
Yeah,
Yeah.
definitely. Yeah, well, there's so many different options, and that's something I think is a great investment. But everybody, there's so much great content that you went over, and I think it's so important to not miss the part of understanding the law, the security laws, and things like that, because I think so many people get tied up in the what they want to invest in, and who they want to invest in, but having a really good foundation of the security laws, and what you can and can't do, and things like that. I think that's something that a lot of people probably miss, investors and and the operators, and that as well. So I think that's a great place for somebody to get started investing passively. Don't overlook this side of the business, and even if you've been actively investing for a while, I think it's good to. The laws change over time, right? And they refresh, and little things here and there. So it's good to be constantly educating yourself on the entire business, and this is part of it.
Absolutely. Well, thank you so much, Peter, for inviting me.
Kim, thanks for being here. This was a great conversation.
It's fantastic.